Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Nam Phan of Pacific Private Money. Mark Hahn may or may not join us today. It all depends. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate. Give it away during the show, and that certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme, general trivia. All right.
General trivia. All right.
General trivia. Yeah, I think you'll do pretty well in this. Nam, you've got a few articles you want to share with us.
Yeah. So, for us on the Pacific Private Money and the Best of Investing radio show, it's all about real estate, and that's so much of what's been going on in the economy this past several quarters is real estate, and this article continues that trend. This is from Inman News. It's and the title is Realogy's CEO reveals why he thinks the hot market will continue in 2021.
All right.
And if you don't know, Realogy is a kind of holding company. They own a number of real estate brands out there, many of which everyone knows about. They've been around for a long time. So they own Century 21 real estate brands. They own Coldwell Banker. They own ERA, which you don't see that much in this area. And they own Sotheby's, and there might be another one that they own too that I can't think of. But Ryan Schneider is the CEO. They had one of their best quarters ever in Q3. They were, broke a huge record. But for 2020, the expected number of home sales by the end of this year will 6 million annualized. Typically, over the last several years, it's been 5 to 5.5 million.
Oh, wow.
And you would have thought, back in March, that everything would come to a standstill.
It probably did. It probably did in March and April, didn't it?
Yeah, absolutely. For us too, there was a significant pause not only on loans but on investments. And then, as people started to see how COVID was affecting their lives, they started making decisions. Many of the people in dense urban areas said, you know what, we want a bigger place. If our employer is letting us work from home, and they're making it permanent, then I'm going to go ahead and just buy somewhere where I can get more land, more space for my kids or my family.
Yeah,
and,
it's permanent. It's permanent until it's not permanent. And
actually, yeah, that'll be interesting to see what happens. And we'll touch on that in a second, but so Ryan's comment here was that, we're seeing a huge year-end, increase in home sales, and that trend he expects to continue into next year, partly because there's been, interest rates are so low. People are continuing to move out of sort of urban areas, and oftentimes they're not moving too far away from those urban centers. So, for instance, here in the Bay Area, they may be moving from San Francisco, but it could be 30 minutes away to Novato. We're seeing homes move very quickly in Novato these days.
But Tahoe is on. I don't want to say on fire. Tahoe is very active right now.
Yeah, and it would be interesting to see how many people are buying in Tahoe as their primary residence, or if it's a second home. I'd be really curious. I think it's got to be second home.
I would think so too. Yeah, I don't know how good the Wi-Fi is up there, but
right.
Yeah.
So his comment is, that with the pent-up demand that's still pent up, and the low interest rate environment, 2021 should be a very strong year for real estate. And we've been talking about that on the show in previous shows, and there's just a lot of data pointing in that direction. What you were saying earlier about it's people will be able to work from home until they can't. I wonder if there will be so many people who have made moves to suburban areas that employers will have no choice but to give those people that option. If you're trying to hire again and you're competing against other companies, let's say in the tech space, and your competitor is saying, listen, we'll let you work from anywhere because you've already made the move, you've already settled into your new home. Other tech companies in that space may say, you know what, we're going to let you go ahead and move or stay where you are as well.
How about companies moving out of the city and saying we're going to take a new office in the suburbs where people can come to work, with a 5-minute commute, so they don't.
Yeah.
That's.
Or as long as they have connectivity, why not? Those corporate headquarters don't need can downsize a lot, and their overhead would be less expensive because it's in presumably suburbia.
Yeah. True.
So that whole city dynamic will be interesting to see how that unfolds.
All right, we'll continue on in the next segment. Here's our first trivia question. First trivia question on general trivia. According to Japanese legend, a sick person will recover if they fold 1,000 of what type of origami? All right, it's kind of an odd first question.
Yeah.
Call 888-912-1190. The first caller with correct answer is going to win that tanning certificate. And then want to make a mention here for the Elk Cove Inn. So they are a COVID safe certified boutique inn and bed and breakfast on the Northern California coast. The Elk Cove Inn is a one-of-a-kind ocean view Mendocino coast bed and breakfast, luxurious accommodations. Go to their website. Beautiful pictures at the elkcoveinn.com. You can also call them at 800-275-2967. All right, stay with us. You're listening to The Best of Investing with Edward Brown and Nam Fan, and we will be right back. Welcome back to The Best of Investing. Edward Brown here along with Nam Fan of Pacific Private Money. Our first trivia question was, according to Japanese legend, a sick person will recover if they fold 1,000 of what type of origami?
You know what? I don't know what type. I imagine it would be any type of origami because it's going to take you like 30 days to fold it 1,000 times.
1,000, yeah. And I think.
And then you're over it anyway.
That's right. I actually think it's other people doing this for you because if you're too sick to do it yourself, a crane. It's supposed to. You make a crane out of origami.
Well, it tells you how much I know.
Yeah, I know.
About.
Okay, so Nam, why don't you continue on? You have another real estate article to share.
Yeah, there's an article also in Inman News. Residential investments push U.S. GDP up 33.1% in the third quarter. So gross domestic product rose 33.1% in Q3 of 2020 due to increased consumption in residential investments, according to the Commerce Department. So people have moved into their homes and now they're making updates. They're buying furniture. They're doing some renovations, but they're spending on housing, and that's what's impacted GDP growth for Q3. Typically, it goes on to say home building and renovation now represents nearly 3.5% of the total GDP. Rent, utilities, and the imputed value of shelter of homeowners accounts for 12% of total GDP. Together, housing is 15% of the economy. Cushy added, business investments increased 20%, but the housing component spiked almost 60%, putting residential investment at its highest level since Q3 of 2007.
Wow.
So that's going back 13 years. So, housing continues to be a kind of foundational strength of the economy today. And, you had a question earlier that you wanted to pose, which is, how will the election impact real estate? Because we're as of the airing of the show, we're only days away from the election, people, the election has been the dominant news outside of COVID for what now, a quarter?
Oh, yeah.
Quarter and a half, but there hasn't been a pause in real estate activity over the last quarter and a half. I mean, well, really since July, so not quite a quarter and a half. But
so people are pulling back and going, well, I think I'll wait and see who wins before I do.
Yeah, I mean, it seems like their reasons for moving are less to do with the who's president than what's going on in their life right now.
Yeah.
COVID, everything else.
In the area that I live, it's amazing all the various construction that's going on. People modeling and just like you said.
Yeah, I mean, you can't say it was is the election and the results are no foregone conclusion. So it's not like people are saying, they've already taken into account who's going to be president and they're making their moves already, kind of like the stock market often does. But this is more just, hey, this is my lifestyle, regardless of what's going on politically. I want a bigger house, or I'm going to, they're in it they have a much longer term view than the next 4 years. So we're seeing that. I mean, we're just seeing real estate continue to be, the bellwether for the economy at large. Yeah. So we'll see what happens after the election. Gosh, I'm not a betting person, so it's going to be too hard to say. All I can
it'll unfold the way it'll unfold. That's all I can say.
Yep.
Okay.
Exactly.
Tell you what, let's we have a couple of minutes here. We got an email from a client. The client is a prospective investor who says, please explain how money sits in a subscription account before being deployed, and does it make sense to send money if it sits in the subscription account, not earning any preferred return?
Yeah. So the question is related to investing in one of our funds, and now we have 4 funds, and I'll describe first that process, and then we can talk about the different funds we have maybe in the next segment. But essentially, when you're investing in a mortgage pool fund or a mortgage debt fund, most of them have a holding account for new investments, for new investor capital, and then you have a working account, an operating account that you use to fund loans, and and when a loan gets paid off, that money goes back into that operating account. And the reason why we have 2 accounts is that working account, you don't want to put new investor capital in there unless you can put it to work. And so the funds sit in a holding account, generally not earning any interest because we may not have a need for it right at that moment. But generally, you're going to, as a fund manager, take in the new investor capital if you think you can place it fairly soon. Okay. And fairly soon for us is generally like 2 to 6 weeks after you make an investment. And so it's sitting there.
It's on a first come, first served basis. So.
Yeah, absolutely. So that answers kind of the other part of your question, which is, why should I invest in the subscription account right now if it's not going to earn any interest? Why can't I wait? And the reason why you don't want to wait is exactly for the reason you just pointed out. It's first come, first serve. So for instance, if we said, hey, we're going to probably be able to place your funds in a month, that doesn't mean, in 3.5 weeks, invest your money, because between now and 3.5 weeks from now, a couple more investors could have come in. Yeah. Several million more dollars could have been invested, and now you're behind all of those people.
Exactly. And the reason you can't accept a whole bunch of money into the operating account where it's got no place to be funded is that there'd be a yield drag, because it'd be unfair to the current investors. If, let's say you have a $10 million fund, and then someone says, wow, this is the greatest thing since sliced bread. Here's $5 million. Well, if you don't have a place to put it, that $5 million mixed with the $10 million is going to bring the rate of return way, way, way down, and that's not fair to the existing shareholders.
Exactly, and that's how you want to couch it with a new investor. Is yes, I understand you have to wait 2 to 6 weeks, however long, but imagine once you're an investor, you're not going to want new investor capital to be diluting your return. So just please wait patiently. And actually, everyone we talk to is patient, because they've recently they're pulling their money out of their bank account that's been sitting there for 3 years, earning a fraction of a percent. Yeah. And so 2 to 6 weeks to wait is not that big of a deal.
Gotcha. All right, we're going to cut to another break. When we come back, let's talk about the various funds, because they're producing different rates of returns. There's reasons for each different fund has a specific purpose. That's why you have more than one fund. All right, here's our second trivia question, just general trivia. What is the only king in a deck of cards without a mustache? Don't you always carry a deck of cards in the back of your pocket there? No? Okay.
Always.
Always, yeah. Just in case a poker game just happens to come along our way.
Yeah, that's right. Is that when you're playing hearts or solitaire, is that the case too? Can you tell?
Yeah, all you have to do is, there's only 4 kings in the deck, right?
Yeah.
Just look at the kings and figure out which one does not have the mustache. All right, call 888-912-1190. First caller with the correct answer is going to win that tanning certificate. Again, here's our question. What is the only king in a deck of cards without a mustache? And when we come back, Nam is going to explain the 4 different funds and how the rates of return are yielding a minimum of 7% up to 9 to 12%. Don't touch that dial. We're going to be right back. Welcome back to the Best of Investing. One more time, I'm Edward Brown, your host, along with Nam Phan of Pacific Private Money. Our second trivia question was, what is the only king in the deck of cards without a mustache?
Maybe King of Hearts?
Yes, and that's also
No
called
way.
the Suicide King, because it's yeah, it's the one that's got a sword through his head.
Oh, hey, when I asked,
go ahead.
Oh, I was just gonna say when I asked, hey, when you're playing solitaire or hearts, can you tell? I meant online. I don't mean the actual deck.
Oh.
So.
yeah, I guess so. Yeah, you should be able to see. You know.
You play hearts all the time, don't you?
I do it on my phone now, and I gotta say that I've learned certain strategies that you don't really think about when the cards are in your hand, versus when you can just look at the look at your phone and you can kind of see everybody. I mean, you don't see what they have, but sometimes the computer is like really stupid, and sometimes it's so unreasonably lucky. So it gets a little frustrating with that. But
that's funny.
I do pretty well on that.
Awesome.
Okay, so we told the audience when we cut out of the last break that we go through the different funds that Pacific Private Money Fund offers, and the different rates and all that kind of stuff. So why don't you start off with one fund and just move to the other? Let's see.
Yeah, and as always, I guess we'll start off, I like to go chronologically, and we'll start off with our legacy fund, the Pacific Private Money Fund. Now in its, actually in its 8th year. So we launched it in 2013. During that time, it's grown to just under $60 million in assets under management. Currently about 70 loans or so. And the fund really is designed to lend on the typical types of loans that we've been originating over the last 12 years. So we've been around since 2008, and those are kind of the whole myriad of loans, from fix and flip to just purchase loans where somebody's buying a home for their primary residence. Could be an investor who's buying a property to hold and rent out. Could be small balance commercial. It could be ground up construction. It's kind of a mixed bag, but it's really designed to be kind of our foundational fund. Very easy to understand. Pays a healthy return of around 7.5%, and that fund again has been around since 2013. To invest in it, it's a minimum $50,000. So all of the funds have some sort of minimum investment amount. For the Pacific Private Money Fund, it's $50,000. The hold period is 1 year, and all funds have a minimum hold period of a year, and then investors do need to be accredited. Accredited meaning that they have to have a net worth of $1 million, or they earn a certain dollar income that they have to show on their W-2s for the last taxes for the last 2 years, and that's $200,000 as an individual, $300,000 as a couple. And now there's actually recent law that was passed that allows people who don't have that net worth but have relevant experience in financial matters or certain professions where they can invest. So you can be like a CPA or an attorney, and that's you'd be considered accredited because
that law passed.
Yeah, you reach a certain level of education. So they assume with that, you're sophisticated to a point where you can invest. So Pacific Private Money Fund, other characteristics. Again, just to reiterate, 7.5 is about the yield. 6% loan to value. Average loan to value. It's just your kind of your vanilla, boring fund, which our investors appreciate.
Yeah.
Then you have the Freedom Fund, which we launched in April of this year. That fund is paying a flat 7%, and so it doesn't go up or down. Where the Pacific Private Money Fund can fluctuate. The yield to investors in the Pacific Freedom Fund is a flat 7%. regardless. And the minimum investment, though, for the Freedom Fund is $250,000. Reason why we have a higher bar for investors is, we won't be growing that funds to, it's not it'll cap at some point. Maybe that's 10 million, or excuse me, maybe that's 15 million, maybe that's 20 million. But we don't have the sort of ambition to grow that to be too large, largely because we use that as a sort of a line of credit for us, or a warehouse line, because oftentimes we're funding loans that we don't plan to hold or portfolio. We plan to fund these loans and then sell them off. Right. And so it's kind of a holding place for these loans until we sell them, which is generally, 1 or 2 times a month that we do that. Right. For investors, 7% return. The nice thing is that you can redeem your investment quickly, faster than you can in any of the other funds we have. And for that, it's attractive. And the 7% is significantly more, appealing than just having your money in a bank account.
Yeah, it's funny. I remember on the Pacific Private Money Fund recently talking to somebody, and they were saying, well, 7.5%, it's too high. It's got to be risky. I said, well, yeah. I get what you're saying, but in reality, if investors like you were willing to lend the money or invest the money in the fund at 3%, then we would go ahead as a company and lend it out at 5.5%, and we get more business. But I said, nobody really wants to invest in a fund that's only paying, 3%. Right. Because they look at it and they go, well, if I get FDIC insurance from a bank at, close to 1%, why even take any risk at all, to try to get just a couple percent more. So I said, that's the only reason. It's the supply and demand. The people who need the money have to pay higher than what a bank would charge.
Yeah, and that's funny because I had a conversation with an investor today, and I described, as I'm describing now, the different funds, and the North Star Capital Fund and the Southwest Note Fund are the next 2 funds I'll talk about, but they pay higher returns. And the investor said, well, does that mean that they're riskier? So let's talk about that. So you've got the North Star Capital Fund.
Okay, we're going to cut to a break when we come to the next segment, because those funds are paying higher than even the 7 and 7.5%, and the audience is going to want to hear that. And then after that, we'll go to deals of the week after in the next segment also. Okay, here's our third trivia question. What was the highest denomination bill ever printed in the United States? The highest denomination. Like right now, I think a $100 bill is the only one you really see that's the highest. But there used to be higher bills. Okay. And if you can give me the year, I'll be very impressed. In the year that it came out. So that's our trivia question. Call 888-912-1190. First caller with the correct answer is going to win that tanning certificate. What was the highest denomination bill ever printed in the United States? And we're not talking counterfeit, because then you can print it.
Not talking monopoly either.
Yeah. 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 All right. Stay with us. The Best of Investing will be right back. Welcome back to the Best of Investing. One more time, Edward Brown here along with Nam Phan of Pacific Private Money. Our third trivia question, what was the highest denomination bill ever printed in the United States?
$1,000?
$100,000 in 1934, which was during the
You didn't let me guess the year. I was going to say 1934.
Oh, I'm sorry. I cut you off there. Yeah. And it was used only for official transactions between Federal Reserve banks.
Oh my gosh,
yeah.
That's
because they didn't do wire stuff back then. Yeah.
Could you imagine the courier?
Yeah.
Who's got to do it? You know what? I put my bag down.
Yeah. Yeah, that doesn't work too well. All right.
No.
So continue on. You had 2 more funds you wanted to explain to the audience.
Yeah. In the last segment, we were talking about how does a higher target return mean and is there a higher risk? And that's conversation I had with an investor earlier this week, and it depends. I mean, it could be a higher risk is equated to a higher return or vice versa, but it's also the characteristics of the type of loan that you're making. And the North Star Capital Fund is the next fund I'll talk about. We launched that in July of this year. The target return for that fund is 8 to 10%. And why 8 to 10? when it's already a half a point or a half a percentage higher than what we target for the Pacific Private Money Fund. And a lot of that has to do with the fact that construction lending is a completely different animal than just making a loan to somebody who's buying a house. You're dealing with builders, you're dealing with a fair amount of unknowns at the beginning of a project. You're looking at the builder, their track record, you're looking at the lot that they're building on, you're looking at the cost of materials and labor and potentially cost overruns. There's a lot more complexity in trying to underwrite and evaluate a construction loan than a purchase where the property already has a market value. And so the cost of capital to builders is higher. We charge more to builders, and also we may take an equity position in the project. Oftentimes that's a carrot for investors for investing in construction is, you can make more, and if you have profit participation when, the project goes for sale, you can make multiple digit returns in those scenarios. But at the end of the day, and we're still conservative in our underwriting and decisions for when we make a construction loan. But that cost of capital to the borrowers being higher than to somebody who's just buying a already built home, it's higher, so we can pass on some of that benefit to the investors.
All right.
So that's the sort of logic why we would have a return profile of 8 to 10% for a ground-up construction fund. For the North Star Capital Fund, the minimum investment is $100,000, also 1-year lockup. Reporting on that, though, is, I should point this out, so reporting and earnings are distributed quarterly.
All right.
Versus for the Freedom Fund and the Pacific Private Money Fund, it's monthly. Okay. So you can take distributions every quarter. And the last but not least, the Pacific Southwest Note Fund was launched in August. And this is a really interesting fund because it's the first one for us that's not, where the properties aren't in California, where these loans are originated right now in Texas. And it's essentially, I could summarize it, it's kind of a seller carryback note fund where we're buying seller carryback notes. So it's really a seller carryback loan. And a seller carryback loan or note is one where the home buyer is buying a home from a seller, but they're getting a loan from that seller for that purchase. And we're buying those notes, those loans from sellers at a discount. All right. And the discount, for a number of reasons why a seller would sell a note at a discount. They've held it for a while. They need cash immediately. They've earned some interest, and now they would just want to exit. They don't want to be the bank anymore. Okay. So there's a lot of opportunities for that. And why can we, operating Pacific Southwest Note Fund, pay a return profile of 9 to 12%? It's because the loan itself is generally somewhere in the 6 to 7% range. We're buying these properties or loans at a discount, and when we get paid off, we're getting paid off at the full amount. So you kind of mix that all together, combination of the rates the borrowers are paying, plus the getting paid off at a much higher amount than what we bought the loan for, and that all blended together can result in a higher return for the investor. The pref on that, the minimum that generally we say we'll pay to an investor is 9%, but we expect the return to consistently be above 10, over time. So again, 1-year hold on this one, $50,000 minimum investment. You do have to be accredited. If you look back, these are all very, very different types of mortgage pool funds. Yeah. So, since we've launched the 3 new funds, we've seen, quite a bit of diversification from our investors who are in the Pacific Private Money Fund, but also other investors who didn't want to be in a fund, and now they're saying, wow, look at all these options I have. So
true. And trying to find individual deeds of trust is getting harder to find.
It really is, and it's because of the combination of funds that we have, but also it's just become a very, very competitive space. So, at Pacific Private Money, If you want to learn about really the 5 ways to invest, the 4 funds in trust deed investing, visit our website. It's www.pacificprivatemoney.com. And I'd like to add, too, that we have a fund event coming up. It's just around the corner, November 18th at 6 p.m. You will be able to sign up any day now on our website. Or you can call us at 415-883-2150, and we'll sign you up. It's a webinar just like we've done for the last, is it 3 now that we've had? Yeah, I think we've had 3. Great way to learn about investing in real estate. Real estate right now continues to be really hot. We just came, as of this recording, we just came off probably the strongest month we've ever had. So it's been a really busy month. Q4 shaping up to be very busy for us as well. It's just been a busy year, on top of the fact that it's just been super crazy.
Yeah.
Yeah, so please join us on November 18th. And to learn about the funds, go to www.pacificprivatemoney.com. If you want to learn about trust deed investing, go to www.privatemoneyloans.com. That's privatemoneyloans.com, and that's where we place our trust deed.
And the best part about the funds, or not the best part, but one of the major aspects of the funds, it's no load. So there's no fee getting in and there's no fee getting out. And all the funds have a 1-year hold, except for the Freedom Fund, which is almost like a money market. The best part is I guess the best part of all of the funds is the fact that the principal just kind of stays the same. It's not like traded in the stock market where your $100,000 could go up to 105 or down to 95. It just kind of
stays. That's exactly right.
Yeah, just the interest rate changes a little bit, except for the Freedom Fund, because that's just a straight 7%. Okay.
Yep.
Very good. Don't have a trivia question, but when we come back, can you give us a deal of the week before we cut out?
Yeah, absolutely.
All right, stay with us. The Best of Investing will be right back with some closing comments. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Nam Vaughn. Mark Hunt was off today. Nam, why don't you give us a deal of the week, because the audience has heard about these great funds, but they don't really have an idea of, give us an example of what you actually do.
Sure. Yeah, I've got a few deals of the week lined up here. This one is, we talk about our bridge loans every week, and inevitably one of our deals of the week is a bridge loan. But this one's interesting because, well, it is a bridge loan, but it's interesting the way real estate agents, if you're looking to buy a house these days, this is something that why you want to have a good real estate agent. So this was a loan, $2.5 million bridge loan that we received that needed to close really quickly. I mean, that's all we hear these days is, I need to close fast, especially on my bridge loan. And this one was about a week. No, actually, this one wasn't a quick close, but it was a quick approval. So it was a 21-day close, $2.5 million bridge loan, but we got it. They needed to submit an offer very quickly.
Okay.
So what happened was this realtor, if you're a good realtor, you generally are networking with other top realtors. So you learn about listings that come up before they hit the multiple listing service and are made available to everyone. And so if you're looking to buy or sell a house, particularly if you're looking to buy, you want to affiliate yourself with a really good real estate agent who's connected with other real estate agents, especially other listing agents in the area in which you're buying. So this home was shown sort of pre-MLS. So before it was put on the market, it's kind of pre-showed to a select number of real estate agents and their clients. And in this particular case, the borrowers went to see this property again before it hit the market, but they had a very short window to make an offer so that they wouldn't be competing against the masses who would see that property on Zillow or any other real estate website. And so they submitted an application to us, and they needed pre-approval so that they could make an offer. And we got this application and the loan processed within just a few hours. Wow. I don't say process meaning closed. I mean, got all of the documents, reviewed them, and said, listen, we can make a loan to you and for $2.5 million. And so they went out and made an offer before it hit the market, got approved. and they were able to close this loan in we were able to close this loan in 21 days. So in this kind of hot market, you really want to learn about inventory before it hits the market, available listings.
You remember the old days when you'd put in a contingency offer and it was like, yeah, this is no big deal, you know?
Yeah. Nowadays, contingency offer, forget about it. You're not going to stand a chance. So, you know, that's just one of the typical deals we do. Another deal we had was a construction loan. This person has a track record buying a home in Napa Vineyard, wanted to build on it, but they're planning to sell it. So this is a developer, somebody who's built a number of homes in Sonoma, Napa area, you know, knows what kind of market it is with people buying from San Francisco into these markets, and, you know, really needed money quickly. And so sent to us by a a mortgage broker who knows that we can fund quickly. And we closed this loan for $1.6 million. They're going to do some rehab on this property and then put it back out on the market, probably for $3 million.
Wow.
And again, people coming to us for fast closes to take advantage of this market.
Okay, so for more information, how do they get a hold of you, and remind them about the webinar?
Yeah. So webinar is November 18th, 6 p.m. And to get hold of us for a loan or to sign up for a webinar or to learn about investing, same number, 415-883-2150. Same website, www.pacificprivatemoney.com.
Very good. All right, thank you, sir. Here's our thoughts for the day. George Washington is the only president who didn't blame the previous administration for his troubles, except for maybe King George. And apparently, I snore so loudly that it scares everyone in the car I'm driving. I don't get it. All right. Tune in next week. That's just a joke, people. I do not drive and sleep.
You drive a Tesla, though, so you can do that.
Yeah.
Right?
No, I don't have one of those. In fact, I thought it was automatic pilot. I went in the back to make a sandwich. That wasn't a smart thing to do. All right. Tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.